Hello, good morning. My name is David Ansara. I'm with the Free Market Foundation, and welcome to our audiences, wherever you may be joining us on your preferred social media platform. And also welcome to members of the media as well. Like I said, my name is David Ansara. The Free Market Foundation is a think tank. We specialize in privatization, deregulation, and decentralized forms of governance. Those are some of the key messages that we want to put out into the public policy space in South Africa. South Africa has a very statist policy orientation, and that excessive state spending and involvement in the economy is inhibiting South Africa's growth. We're speaking on the morning after the medium-term budget policy statement, and we saw something of a holding pattern from the Minister of Finance. We at the FMF released a press release to say that FMF bemoans balanced but bloated government or bloated budget. And, I think while some commentators have been praising the relative conservatism of the finance minister, ultimately what we're dealing with is an extremely large and bloated state. We have about 1.2 million people out of a working population of 16 million people working for the government in some capacity. State spending is way out of control. We have a 75% debt to GDP ratio projected in the next financial year. So something has to change. And we also have these extremely broken and dysfunctional state-owned enterprises. So this has prompted us at the Free Market Foundation to engage in some substantive policy research. And this project is called the Privatisation in Practice project. And I'm delighted to be joined by the author of this special report, which we will be making available on our website and in the description below and in the comments below. This is authored by Dr. Christoph Klein. He is a specialist in economics and infrastructure financing in particular. He has a background with the Free Market Foundation. He's an associate of ours, a longtime associate. He's based in Germany, but he did live in South Africa for 10 years, so is very familiar with this market and the regulatory landscape, in particular with regards to telecoms infrastructure. He assisted us with a paper on telecoms deregulation and spectrum in South Africa. This was many years ago. And also assisted us with submissions to regulators like ICASA, for example. He holds a PhD in economics from Rey Juan Carlos University in Madrid. And so, Christoph, welcome to the stream. Great to have you with us. And so just in terms of some basic housekeeping, we're going to be having a brief presentation from Dr. Klein. He's going to just take us through some of the key findings of the paper. And I would really encourage our audience to go and check out this paper, Privatisation in Practice. But before we start, I just want to say a very special thank you to the Konrad Adenauer Stiftung. CAS is a very important partner of the Free Market Foundation here in South Africa and very generously supported some of the costs associated, all of the costs associated with this project. So we're delighted to be collaborating with them on that. All right, Christoph, well, I'm going to hand the microphone over to you. And I think it would be very useful for us to understand, particularly this theme of privatization with regards to South Africa's infrastructure problems. I think infrastructure really is a key problem in South Africa. We've got essentially our infrastructure networks are crumbling all around us, whether that's road, rail, ports. Electricity has had a moment of reprieve, but some significant problems still remain there. And I think there's great benefits to embracing privatization. But Christoph Klein, over to you.
Okay, thanks, David. Thank you for having me and giving me the opportunity to present a few of my findings. I don't want to be too long, too excessive on the slides. So what's important to me always, having done a PhD in Madrid actually on infrastructure finance and in fact, accountability, public accountability in infrastructure, production, in supplying the services, and obviously in financing the infrastructure. I always try to first engage a little bit in economic theory. And David, if we go to the first slide, before we, let's say, go into theory, what's important to understand, you can just flip until all the pictures come in. I just want to give just the first slide, please. There is a few, the introductory slide, in the public discourse, exactly that. So what you see here is a few quotations that demonstrate how important the infrastructure discourse or the funding of infrastructure is in everyday politics. I mean, we're talking about huge budgets, also for university professors, and it's one of the channels through which politicians can influence economic life. And as such, actually, this is happening. Each time there is an important policy statement, let's say a new government is coming into being, and they present their budget, their plans for the next legislation period, you will find something on infrastructure. And it's like they will say that they, as a state, have to take care of the provision of infrastructure good. And this has to do with some economic theories that go a couple of decades back, just after the Second World War. We will talk about it. So this first slide is just to present a few of the players in the infrastructure market. Yeah. So I think we can move on. David, yeah, on the next slide. Yeah, now we should see actually some of the, just carry on until all the pictures come in, and you will see like the time and some important reports there. Yeah, okay, now we have the common ground actually. So if you
should I go back there, Christoph?
Yeah, please. Yeah.
I think some of those pictures may have dropped off, but
it seems like, but it's not too important for what we're trying to say. So there is some common ground actually, that obviously it's crucial for economic development and the overall productivity of the economy, and in essence, it's positively related to all definitions of human thriving. So if you look at the very developed economies, obviously they have the most extensive infrastructure networks. What you then see is that between low income, I rather talk about low and lower income countries and higher income countries, just that notion of development is always a bit tricky. So obviously capital stocks and diverse infrastructure is a proxy of welfare. That's completely clear. Everybody is acknowledging that. And but to derive from that the public has to become engaged is a completely different matter. So we will talk a little bit about that one. So what you see on the right side is actually where the disagreement comes in. Yeah. So first of all, what is infrastructure? In fact, is it assets? Is it networks? Is it actually institutions like hospitals, for instance? So there's actually no clear definition, and I try in my PhD actually to work a little bit on it. Then how infrastructure actually came into being. I mean, historically, technically, financially. If you read today's papers, authors are actually not talking about that one a lot. Yeah, they like to start with the time after the Second World War, and by then, obviously, all the infrastructures were in public hands as a result of the war economy before, and that effectively is a situation we have until today. Yeah. So yeah, then another point is what was actually first, infrastructure or development? And this is a very important one, because first you need, let's say, some kind of income generation before you can actually invest in long-term capital development. Yeah. Today, the discussion, very often you find, whether it's the World Bank and other think tanks, that you have to invest in infrastructure to foster economic development. This in fact is not really correct, because you cannot just assume high incomes. Yeah. So that's a basic point. And obviously then there's a disagreement on whether there is systematic failures in infrastructure markets, so as to justify the role of the state. Yeah. So yeah, so there are more questions than clarifications, and we want to talk a little bit about why the natural monopoly theory has played a crucial role in economic history. So we can move on, David. Yeah. So this is a very busy slide, but what I would like to say is that as an example, for instance, the energy sector in Germany, there was no state until the First World War began, and even thereafter. So we think that like electricity networks were financed and always owned by the state, but that's actually not true. In Germany, there was already a grid connection rate of 95% by 1914. So it's immensely high. And at that point in time, there was no central state as we understand it today. Yeah, and by actually 1930s, 90% of all farms were connected to the grid in Germany. So really the rural farms. So what it does show is that finance and markets are able to cater for infrastructure provision. Yeah, and as I said, with the war economy, centralization was obviously necessary, and after that it was never actually wound back. So the birth of state-owned enterprises as we know them today came actually into being in the 1930s. Yeah, and with that, which is quite interesting, it came the theory of natural monopoly, which basically provided an ex post justification of public ownership. Yeah. So I always refer to a paper from 1968 from Harold Demsetz, who was stating in that paper that the theory of natural monopoly is actually exceedingly brief and exceedingly unclear. You could also say it's very primitive theory, and it's just amazing that the theory is still being referred to until today. Yeah, if you read through all the regulatory papers of states, or let's call it rather not papers but policy approaches, they will always refer to market failures and that the state has to become engaged in public infrastructure, because otherwise a monopoly will ensue and they will rob basically the people of their income. Yeah. And we will see actually on one of the next slides that this is not happening. There are many other examples you can find in the paper by the FMF about postal carriers in Germany and South Africa, what happened. But a counterexample is actually the mobile telecommunication sector, which from the very, very beginning was a private undertaking all across the world. And what most people don't know is that the big breakthrough in mobile telecommunication was actually the prepaid technology. It's a rather simplistic technology. It's basically a kind of commercial mechanism to allow people to prepay instead of having a postpaid account where you need, a credit vetting, a formal address, and mostly a salary slip. Yeah, so that was the case actually in the 1990s. And prepaid basically changed not only the mobile telecommunication industry, but the internet completely. So through mobile phones, actually, it's that more than half of the world regularly access the internet, and not through desktops or notebooks or tablets. Yeah, so that's very important, and that was all achieved by completely private markets. So in terms of the national monopoly doctrine and what it did, the consequences were particularly disastrous in low-income countries, because utilities, as we know them in the Western Hemisphere, were actually hardly financeable in developing countries, because they just did not have, and still don't have, the high tax incomes in order to provide for a universal service for 95 or 100% of the people. And the best example to show what happens if you distrust markets and have natural monopolies, we will see on the next slide, where we show a little table. Yeah, so what you can see there essentially is the development of the fixed telecommunication market. So basically copper lines. And if you click on, David, then what we will see is that a few errors are coming in. And I want to focus on the lower row in the low income sub-Saharan Africa. So they started in the 1960s at 0.02%, yeah, exactly there. And 35 years later, it's 0.09%. So basically what it says is there is no universal service, but universally no service. Yeah, so that's the irony. The fear was that if you let markets come in, that people would be robbed of their income. Yeah, you call it consumer rent. Yeah, so market abuse and so on. But what you can see here is actually that no market in fact existed. Yeah, those few fixed line connections were basically all financed by the state and by some bigger enterprises. That's it. There was no fixed telecommunication for ordinary people. And this is, let's say, for me, always the most striking example how bad the idea of natural monopoly fared in lower income countries, and even in lower middle income countries. It was very, very low penetration rates. So in fact, the model that kind of worked in the Western Hemisphere, because the incomes and the tax base was sufficient to allow for inefficient public operators in countries in sub-Saharan Africa and other lower income regions, it drastically failed. So yeah, that's a key outcome, that there was essentially no service. And then we can move on to the next one. And yeah, is it actually, what's always being said, that infrastructure is a distinct economic category. So economists have heard about economies of scale, and that there are certain industries where only one player has a space, and not a second will enter because of certain economic reasons that don't hold water, like that incumbent can always lower the price so as to avoid market entry. But what they forget, obviously, in neoclassical models is that there's innovation and there's competition also in the supply chain. So that's the biggest problem of SOE markets. They are basically closed for innovation, or at least it takes a long time for innovation to trickle through. And if you then, have a look at economic theory, then we must realize that there is no economic theory that differs across different groups of services or goods. There's only one economic theory, and that economic theory does apply equally to, let's say, infrastructure and, let's say, food markets. So that's why I bring here I distinguish between electricity and milk. And essentially, if you go through economics, you need demand. So people demanding the service, you need people and firms to produce and supply. Sure. So you have the supply side. You need obviously people to invest. In order to invest, you need to save. So their finance markets come in, very important. So railway sector, for instance, was instrumental to creating the finance markets as we know them today. Before there was finance, but more trade finance, not really long-term finance. So with infrastructure came long-term finance as we know today. And then obviously you need an intermediation mechanism, and this is the market mechanism itself. You need allocation. So this is prices and profits, and prices also are salaries. Salaries are also prices. So if Eskom is supplying, like employing, let's say 60,000 people at inflated salaries, this is not a market price. This is essentially a policy price. So the key feature of electricity in economic terms is actually that it is electricity. It's unique, as is milk. So this is very important that we see that economic theory does not distinguish between different classes of goods, services, and so on. And if people, let's say, insinuate that infrastructure is a different category, or that any kind of good is a different category, must be very careful with that. At least when it comes to let's say economic policies, which always come with mandates and obviously with power. And SOEs in South Africa are a particularly good example that this power game is hurting people. So on the right side, there is a box. There are some characteristics of infrastructure, like capital intensity. You can click it down, David, a little bit, then we see the other ones. Yes, you have economies of scale, but that doesn't mean that there is no competition or that competition is not possible. They are durable. Milk is not very durable, but if you have a transmission network in energy or that, it's spatial, and it is. You need a network. You need an extensive market. Otherwise, you can't finance it. And you have this network character, which is probably the best explanation or the best feature of infrastructure. So this is a key feature in my mind, if you want to distinguish it from a technological perspective from other classes of goods or assets. David, we would now talk a little bit then about de facto privatization. What does it actually mean? And before we go into the findings of the paper, let's say have a few. Let's start with just discussion on the points, and we then might come at the end to this slide.
All right, Christoph, thank you very much. I think that was a really good theoretical, high-level overview. I think it's very important. I think sometimes we get stuck in a specific paradigm, particularly in South Africa. And I think it's good to actually assess the first principles here. I think a big takeaway that I had from you was that really the Second World War really changed the paradigm, that there was this wartime need for nationalization of key resources. But then when the war ended and the guns stopped firing and the bombs stopped dropping, then the state in many of these Western countries still continued to hold on. And then the monopoly, the natural monopoly theory was sort of justified in retrospect, ex post facto, as you said. So yeah, I think what I would like to do is maybe just kind of bring it into the South African context a bit more. You mentioned mobile telephony, and yeah, I think that's an area that we take for granted, that we have millions of people. I think we have more cell phones in South Africa than we have people, right? So the penetration of cell phones into the hands of everyone, rich and poor, I think is a remarkable achievement. And very much, I think also that distinction you made, just because it is a good or a service that we label as a network industry or something important like that, doesn't mean that it cannot be used privately or provided privately. So yeah, so I'd like to maybe kind of unpack that a little bit more, this theory of natural monopoly. Why do you think we're so fixated on it?
I think we are fixated on it because we all recognize that the services that infrastructures deliver are important, yeah, and for everyday life for people. And there is obviously so justice or notions of justice attached to it. And each time actually you talk about justice or fair, let's call it fair prices, yeah, it's rather easy for politicians and regulators actually to jump on the bandwagon and claim that we need to have affordable infrastructure services for everybody, yeah. And as much as I personally wish that to happen, yeah, it doesn't work that way. Yeah, you still have to create markets that, yeah, have to provide such infrastructure services at, let's say, cost and with profits. And what we see in South Africa, for instance, like with Eskom, it's a very costly service, yeah, and you cannot just take the prices that you pay in the market, yeah. You have to add to it the pension obligations, the budget deficits, the guarantees that are piling up on the national balance sheet, and all that is actually impacting on the people's finances, yeah. So those huge budgets and guarantees could be used somewhere else, actually, if there were an efficient electricity market, yeah. And of course we can have an efficient electricity market, so there's no need actually to centralize infrastructure in the hands of one big incumbent, and there's certainly no need to prohibit, let's say, for instance, municipalities like the Western Cape to build up their own energy markets, to procure their energy where they would like to source it, and also obviously to build their own transmission networks. Yeah, all that obviously is if not prohibited, then certainly tightly regulated by national governments, and yeah, so it's a big problem.
Yeah, so I received a direct message here, which I've posted in the banner below. And I think it's a very good point. So the paper suggests that the concept of natural monopoly has been abandoned in high-income countries, as we saw in your table, but still influences policies in lower-income countries. Could you elaborate on alternative frameworks for managing critical infrastructure in low-income countries that avoid the pitfalls of public monopolies?
Yeah, so the aspect is that the model of SOEs was basically exported, yeah, as the only, let's say, approach to providing infrastructure services, yeah. And ironically, developing countries were particularly not suited actually to cater for that model, because it requires massive resources in the first place. So you need a very, let's say, generous tax base, and you already need high incomes, because obviously that allows, let's say, to government, to tax like 95% of the people, and it allows most people to pay a price for energy or electricity that people in low-income countries are not able to pay. You cannot pay like in Germany. We right now pay like on a monthly basis, like between 50 and 100 euros. So that's quite massive. And in low-income countries, this is not affordable simply. So you need to think of other solutions, and those other solutions always existed. I always bring the example of China. When Mao died and they said goodbye to socialism and introduced market principles, so that was Deng Xiaoping. What happened is actually that the development was premised on hydro schemes, small hydro schemes of municipalities, very local, very decentralized. And until today, more than 50% of national power in China is actually delivered to local hydro schemes. And this is, if you want to say so, a private asset. It's being managed and held by the municipalities, and people are employed locally, and they finance it locally. So this is a kind of decentralized energy provision that could have happened everywhere around the world. Of course, you don't have everywhere hydro like in China, but there's different means then that you can work with, captive power plants and so on, which are more local and not managed as a central utility. So there's always market solutions if there is need, and obviously income to pay for infrastructure services. And mobile is the best example. I mean, like in the 1990s, when the first networks were switched on, all economists, even all the bright consultants like McKinsey and so on, they thought this is a service for the affluent. It will never fly, because postpaid tariffs were like $100 a month at that point in time. And so it was for politicians, it was a gimmick. Essentially, they thought, actually, let's focus on something else. And so a couple of years later, prepaid was invented. And we see today that in most low-income countries, there's hardly any fixed line anymore. There was never actually a fixed line. So nobody is using a fixed line anymore, not even in Germany, except in offices. So most communication is actually being done either through like Teams and Zoom and other kind of video conferencing facilities, and obviously through mobile. That's it. So that's a huge success. David, I cannot hear you right now.
I think we can be grateful that central planners were disinterested in mobile telephony, because they maybe would have regulated it to death. And I think it's just a good example of how it's really impossible for any central planner to forecast how these market dynamics might play out. And often there's a status quo bias. You're kind of thinking about the state of things as they are rather than how they might develop. But now this change occurred that is completely normal to us, that we use these devices and that we pay prepaid. Most users pay prepaid. All right. Well, Christoph, are there any other points that you'd like to make from these slides? But before we go there, I just wanted to encourage our audience to please post their questions on whatever platform you're watching on, and we'll try and showcase some of those questions as well. But in the meantime, we'll just continue our conversation. So, I mean, I think we've touched on some of these points here, Christoph. Is there anything else that you would like to just return to? I mean, I think particularly in South Africa, I think there's often a conflation between privatization, which is selling state assets, and liberalization. Do you want to maybe just provide some clarity on the difference between those concepts?
Yeah, so if you take Eskom, you will note how difficult the situation is. So nobody at the present point in time would buy Eskom, not even for $1. Yeah, the famous $1, because it's loaded with contingent liabilities and debt. Yeah. So not least the people that are employed, and they all have pensions and so on. So if you think you have a big bank by privatizing Eskom, this is probably the wrong way. What you really need, and this doesn't only apply to, let's say, energy markets, you need a opening of the market, liberalization of the markets, like it happened in the 1980s, starting in Great Britain, and then in most other countries across the globe. You need to open the market to let competition enter, to have more dynamics in the supply chain, to introduce competition, and actually to allow substitution for even public services. So in my personal view, the best you can do is actually to bleed out a vehicle like Eskom over time. Yeah, it will be much less toxic as if you tried now to privatize it, apart from the very difficult political process that such privatizations would involve, because you would immediately talk about, let's say, justice, and what about the poor that maybe cannot cater their electricity needs at private markets. Yeah. So this is, for instance, one of the points I want to make. Yeah. A second example in South Africa that's probably very good is in point 2, that you allow for parallel provision of services, yeah, which is essentially a competition. If you take, for instance, the postal office operator in South Africa, I mean, I'm not aware of anybody actually that makes use of their services if it's really important. Yeah. So then you use a courier. And there was never actually a justification why a postal provider should be in state hands or should be regulated as a natural monopoly. Yeah. So there is no economies of scale or something like that. Yeah. So and there is markets in other countries where always private providers actually have delivered your mail. So this is one of the examples in history where the state has essentially took over control of obviously a crucial service, probably also for let's say notions of state security and so on and so forth, and in Cold War times and so on. Yes, I understand that, but again, from an economic perspective, there is, let's say, few arguments that speak for a public postal operator.
Yeah, I mean, I think that's just a good example. I mean, when was the last time that anyone in South Africa, I challenge you, sent something in the mail? And I suppose, I mean, a lot of development type economists would say, well, you know, it's the poor that rely on these services, and that therefore we have to service these remote towns, for example, with the postal carrier, and that their argument would be that markets wouldn't serve that function. But that does imply that there is some basic inefficiency and a lack of economic value in doing that, right? So somebody has to pay within the system for that, and that you add all of these inefficiencies, and you actually end up with a very sluggish overall economic performance.
I mean, one additional point is in Germany, people are still using, let's say, ordinary mail services, yeah, because it works, yeah, which leads to a funny situation that like insurances, banks, leasing operators, health insurance companies, they all send their mail still through physical, let's say, postal operators. Yeah, in South Africa, even like 10 years ago, when I was living there between 2011 and 2020. Basically, all the important documentation, even legal docs, you could actually handle through electronic signatures. Yeah, so you have a solid legal status. Let's say producing electronic documents and signing contracts electronically. Yeah, so this is a big advantage actually, that if a service doesn't work, you substitute it by better means, which happens through digitization of postal mail. Yeah. So in Germany, there is no need, and we are now very inefficient in terms of still, let's say, sending back and forth, let's say, millions of tons of papers. Yeah.
But I think that's a good example of how these state-owned enterprises and these legacy systems can actually crowd out innovation and new, better, more efficient alternatives. All right, is that it for this slide? Can we move on just to a general conversation?
Yes, of course. Yeah.
All right, great. Well, Christoph, yeah, I mean, I think one question that came through to me directly, which I've posted here in the chat, which is how would electricity prices be regulated if Eskom were privatized? And I think most lay people might fear that if there was a privatization, you'd see electricity prices going through the roof and poor people being unable to afford it. But as you argue in that analogy with milk, right, there is a demand for this product, and the distribution systems would be there, and there would be also, in my view, high prices would send a signal to the market that there are profits to be made, and that would lead to an increase in supply, and that would push downward pressure on prices. At the moment, we have a regulator, NERSA, that basically determines through ultimately a negotiation with the sole electricity provider, Eskom, what the prices should be. And so everybody's outraged when Eskom proposes a 30% hike to NERSA, and then there's some kind of back and forth. But we don't actually know what the real cost of energy is in South Africa. It's impossible to determine without that market signal being in place. So I think, as Hayek told us, prices are a signal, they convey information. And at the moment, we're distorting the price signal. What do you think?
First, before I answer the question, you have some price signals, and these are solar plants, and wind farms. So there have been some, let's say, successes in feeding in wind and solar power into the grid, and by now this is by magnitude cheaper than actually the electricity being provided by Eskom. Obviously, we must understand that wind and solar energy is probably not the right energy to, let's say, power industrial plants like smelters and so on. That's completely understood, but that doesn't mean actually that we need a regulation. So coming to the question, how would electricity prices be regulated if Eskom were privatized? I'd say, why regulate in the first place? If you think obviously about let's call it poor people, and that the prices could skyrocket for a certain time, and some would not be able to afford it anymore, I would not handle that through regulatory policies. I rather would give out, let's say, budgets to people, like credits, social credits, social grants to pay for it, instead of intervening in the energy market, because that always, let's say, sends a wrong signal and distorts the allocation mechanism in the market. So
rather not mess with that signaling function, but if you want to provide welfare, do that separately. I think there's probably costs to that as well on the fiscus and so on. But
so that would apply also to water and all the other, let's say, crucial services provided by those infrastructure networks. Yeah, let the market play out. Let the people earn money without a profit motive. You will always stick to companies with like Eskom, and that in the end makes everybody poorer.
I think the profit motive is a great driver, but when we think of free market capitalism, we also think of profit and loss, right? So if there are uncompetitive firms in the market that are working inefficiently or their product is not valued as much, they will fail, and the market will clean out those ineffective performers. But at the moment, when you have this natural monopoly, if the central utility fails, then that ripples through the whole system, and Eskom, as we've seen over recent years, has been a choke point. So at the moment, we have some reprieve, and I'd argue, unlike some other analysts, that it is more because we've had some liberalization of generation rather than, and I think some common sense has prevailed in terms of refurbishing coal-fired plants and not decommissioning them. But, I think still the concentration risk is very real. And then we also have problems of distribution as well, that the reticulation systems in municipalities are also breaking down. And so we need a lot more competition there. So it's fine if Eskom is producing lots of power and transmitting it around the country, but if you can't get it to your house through the distribution network, then it's pretty useless. But what would you say, a bit of a curveball question around liberalization or privatization of transmission grids and distribution?
Yeah, so transmission is a bit more tricky because it requires a long time. Yeah, and what you have in energy markets is this unbundling, where you unbundle basically generation, which is happening as we speak. Yeah, that's the easiest part. And then transmission, which is more the long distance kind of networks, and then obviously distribution. Yeah, so there's no reason why distribution should not be privatized. Yeah, that's also easy part. Yeah. And the transmission, you should put these assets into a special purpose vehicle, and this might actually then become, after a while, a healthy kind of asset pool, driven by market prices. Yeah, this as we speak right now is not the case. Yeah, so. Another very important point is in order to have competition and innovation, you need accountability. Yeah? And obviously, public entities, by definition, cannot be accountable because there's nobody to account for. There is no equity involved, personal equity and risk to lose personal assets. When it comes to public entities. This is why an Eskom can go on forever. Again, by definition, they cannot fail.
Yeah, so Eskom has one shareholder, the government. Exactly. But there's this sort of notion of collective responsibility, but actually in that system, nobody takes responsibility. Nobody bears the cost and the consequence of their inactions.
It's actually non-entity. Yeah. So the public, if at all, you could say it's a taxpayer's base, but without, so it might be considered as a shareholder, but this is then a shareholder that doesn't sit at the table. Yeah. Okay, you can vote. Yeah. But this obviously doesn't work because of rather short political periods. Yeah. So there is certainly no economic accountability. There's a certain degree of political accountability, but you finance infrastructure networks over many decades, yeah, and that doesn't go well with the short political legislators, yeah.
All right. So, well, yesterday we had the medium-term budget policy statement, and there was some talk there around opening up South Africa's uh, transport infrastructure. So it's well documented that the fate of Transnet and PRASA, the rolling stock there the volumes have diminished quite dramatically in recent years. The ports suffer from congestion. If you look at the World Bank rankings, South Africa's ports are some of the most inefficient in the world. And yeah, so, I think the conversation there, maybe it's encouraging, but I don't think goes far enough. So there's a sense of, well, we need to draw on private pools of capital and technical expertise to help government. But I still think there's a misunderstanding fundamentally of the role of profit-seeking enterprise, right? That I think the private sector is being asked to shoulder a lot of the risk and to provide the capital, but they're not really being allowed to take advantage of the upside. And there was a lot of mention of this build, operate, transfer structure, which is the BOTs. And the finance minister says that this is an important way for financing public infrastructure. We're developing a blended finance risk-sharing platform that issues a credit guarantee vehicle that will help de-risk public sector projects. So that's good, the decentralization. But I think the problem there is in terms of my understanding of the BOTs, you have the right to build and then operate that entity, whether it's a toll gate or a port. And then at the end of the window, you have to transfer the asset back to the state. So what incentive do you have to actually maintain that asset for the long term to make it more efficient? Why not just let the private sector fully own these assets?
Yeah, that's exactly the right question. So according to my experience, private-public partnership and BOT models, where there is that notion of risk sharing, they never work. In fact, you combine two different types of economizing that cannot go together. And the problem with BOT, you mentioned it, you have no long-term incentive to innovate and invest into your infrastructure if you know that after 20 years you want to hand it back. Yeah. And if governments or, let's say, clever lawyers think they can devise a contractual scheme to avoid that fate, yeah, it's naive. It never worked. It will never work. And you will always find ways and loopholes to circumvent clauses in contracts. So BOTs never work. Yeah. So, but this is one of the mechanisms where the government kind of tries to tap into private finance, but keep a foot in the door. And I find that very toxic. So then I would prefer actually a completely fully owned and responsible public operator. Then I actually understand what I'm going to pay for and who bears the brunt if something goes wrong, politically at least, not economically. Yeah.
So do you think there's a risk of this, again, dilution of accountability?
Exactly.
Yeah. Okay.
And to think that through these mechanisms actually to raise funding, it's also a bit naive, but in the end, it is going to be very costly for the public because those operators obviously want to earn their money, and they're going to, let's say, find a mechanism to derive the profit without actually really innovating and investing in the infrastructure. And you have a second problem. By that, you again circumventing markets, and you by concessions and concessionary schemes, you actually do not get the full credit of competition innovation. So I think private-public partnerships are not a good idea.
And there's also opportunities for political rent seeking. That who is it that gets those concessions? Yeah.
I mean, there's another more technical point. If a government disperses a government guarantee, it's contingent because you don't know whether it's loss making or not. But by definition, contingent liabilities, a certain percentage actually convert into, let's say, real liabilities. So it's a kind of sword of Damocles, actually. If the government piles up contingent liabilities massively, and this is a trend you see all over the world, because it's easy for the finance minister actually to keep the debt, let's say, levels, at least in officially, as a percentage of GDP, because those contingent liabilities are not being counted. So this to me is one of the key reasons why it's so attractive for politicians to engage in private-public partnerships. They can hand out guarantees without actually that becoming immediately visible in the debt metrics.
On the balance sheet. So it doesn't necessarily show on the balance sheet in the public account, but it's that risk is lurking for taxpayers.
It's lurking.
Yeah, I mean, I think just to go back a few steps to your point around municipalities, my colleagues and I this year, before the elections, were campaigning quite hard on a project that we termed the Campaign for Home Rule, which is around pulling power away from the center and down and out to where people are living their daily lives at the local level. And we have a federal constitutional structure, but we don't really have a culture of federalism in South Africa. And that was one of the points that we were wanting to make. And my colleague, head of policy at the FMF, Martin van Staden, he was making the point that there's a doctrine of necessity, that when the central government fails in its mandate, self-acquired mandate, to deliver these services, because the center can no longer hold, the center's breaking down, then people at the local level have a duty to actually start acquiring these powers. And we have actually seen many community groups, business associations, particularly in smaller municipalities, starting to take over sewage works and water reticulation facilities, and doing essentially the duties that municipalities should be doing themselves. And the finance minister yesterday said that I think something like 50 municipalities are under some kind of financial review process. So that's a huge risk. And how could embracing privatization, doing this in a bit more of a structured way rather than a kind of a piecemeal way, how could we actually start to solve some of these problems at the local level?
I think the first aspect is finance autonomy, on a municipal level. And if we again go back into history, until the late 19th century, there were no nation states with the humongous budget as we know them today. So it was implicitly federal and municipal, because there were no national income taxes and no VAT and so on. So most of the infrastructures and what you needed to provide services of public life were actually funded and provided on a local level. This very important lesson of history, because we need to go back actually to more accountability on a municipal level. And South Africa is a fantastic example, because not only have you lost economic accountability if you create state enterprise SOEs, you're also losing political accountability, because what happens if you have a centralized energy grid and it fails? Then the political body in the city or in the municipality, actually, they will show to Eskom and say, oh, well, that's a national operator, and I don't have any means actually to circumvent that or to come up with another solution. It's just as it is. So that way, you also lose political accountability on a local level. And this is what we see in South Africa. It's not only there, but so the dire financial situation in many municipalities is exactly for that reason. There is no accountability, neither economic nor political.
Yeah, so privatization is not just about handing over the family silverware to the capitalists. It's actually about taking ownership over the
Yes.
problems, and it's people who solve problems, not governments, ultimately.
Yeah.
Dr. Christoph Klein, I wanted to thank you very much for sharing your time and your expertise. I think that this paper is really worth a read by our audience. So please do go and check that out and engage with some of the insights there. I think it's a very important document, particularly in the context of where South Africa finds itself. We do have a new government, the GNU, but ultimately the problems that are besetting our country are going to be solved at the local level. All right. Well, I would like to just say thank you once again. Also, thank you to our partners at the Konrad Adenauer Stiftung for supporting this project. And we're continuing with our Liberty First series as well. So please do tune in next week next week, Tuesday, for another broadcast. We'll be talking about the regulatory burden that is imposed by the state on businesses in South Africa. That's it from me, David Ansara, at the Free Market Foundation. Remember, stay free.